Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris rapeseed, Winnipeg canola and Malaysian palm oil markets. I'll start with Paris rapeseed. Last month I stated, and I quote, "This market has recently been one of unfulfilled disappointments. It's all happened since the unfulfilled potential of the late summer ascending broadening wedge pattern, which deviated with a false break lower and tempted all with a possible mid-September to date possible bullish halfway hesitation. It has all been a series of unfulfilled disappointments." End of quote. Now I still feel that way, but at least we are now seeing the beginnings of a possible move. It all started with a failed weekly key reversal up from 4 weeks ago. Now this failure set the stage for a move lower that was countered, but in a very indecisive way, 2 weeks ago, leading to a bearish counter to the third degree before prices finally moved lower and created a monthly key reversal down for November. This sounds a grand action, and it was, but it is also on its own, as there was no corroborating move lower in any other oilseed or vegetable oil. The move lower has morphed the whole action since September, yet again, into another possible pattern. This time it is to look at the June to date action as a possible bearish bump and run reversal top. Now, I'm in no way certain of even this pattern, as it is the latest in a series of revolving door patterns that have cropped up. However, the recent action is suggestive of such a pattern, with the trend lines split for this pattern, currently either 645 even or 623.5, depending where you measure it from. During the making of this pattern, the most recent action, since mid-November, is indicative of a new, quite wide bear channel, currently 607 3/4 to 659 even. Additionally, now we have the rising medium moving average, currently 609 3/4, entering the mix. This is the first time it is coming close to the market since June and July, when it successfully defended a key market drops. As I said at the beginning, there had been some disappointments here in recent times. I'm hoping these patterns now bring some order to what has been an awkward market. Winnipeg canola. There are, as I've previously said here on many occasions, two patterns in operation here, both running to fruition. They were originally a descending triangle from early July and a sideways triangle also from July. Targets for both of these were reached 3 weeks ago, and since then prices have gone sideways at a lower level until last week. At that time, prices broke out of the ascending, expanding, or broadening if you like, wedge pattern formed since October. Interestingly, dropping down on a closing basis only as far as the extension of the lower uptrend trend line of the sideways triangle, currently at 963.10. In reality, I suspect the two rising moving averages, that's the medium moving average, currently at 911.80, and especially the short medium moving average, currently 944.20, that have been shadowing the trendline extension, were the main reasons for the market to turn around back up. However, the move up from the middle of last week has since run into the same congestion in the 1007, 1008 area that has been there over November and actually dates from May, when the market last tried to push up through those levels. It therefore seems to have some pretty strong supports and resistances below and above the market, almost a bracketed market. Question now is whether the market will get squeezed by the rising trend lines and the trend line, actually not trend lines, and moving averages, plural there, combination. Well, I'm not sure, but I do know that the trend line and moving averages are rising each day by about $1.70 Canadian a day. They will start interfering with each other properly from the start of 2022. Bursa Malaysia crude palm oil. First off, please continue to ignore the color changes in labels on the daily chart. There's no special significance to them. It's just my charting system playing silly buggers. Anyway, the move up from the low to the high back 11 weeks ago gave us a weekly key reversal up that very same week. The follow-on higher, especially the gapping moves higher, gave us a rare monthly key reversal up here in September. So why were these moves so anticipated and important in my eyes, other than as their own standout patterns? You see, they were the final elements of a very, very large bullish pattern. If we look at the whole of the May to October action, including the sideways weeks over August and September, then we can see an extended V-bottom. This pattern is not that common, but it did have some heavy merit here at the time. And by heavy, I mean some really heavy merit. To give you an idea of the potential, if we looked at the action since the low July up to the high in August, then you could see the size of the potential move higher of at least the size of a simple bull flag stroke bullish halfway cessation pattern. I gave initial upside area target in the 53.75 area. Originally that was way beyond the top of the market and a very, very big ask. There was an even bigger secondary target for this pattern up in the 55.25 area, but I'm not going to go into that one. Anyway, prices didn't quite make it to 53.75, peaking a little under 53.26. What was within spitting distance of the target since mid-October, when this happened, we've now gone since sideways, or rather supported at the same time, piercing the middle time, currently at 51.99, of the bullish Andrews picture for the same move. The piercings of this middle time initially had limited effects, as though we've seen prices below the middle time a few times. Initially, there had been a single close below. That was until 2 weeks ago, when prices made on the Tuesday a combined key reversal down, bearish engulfing pattern and bearish opening black Mariposa, followed on the Wednesday by a hammer pattern, both closing below the middle time. And that was significant. Since then, prices have made an erratic move lower, below the rising short-medium moving average, currently at 49.72. This move below the short-medium moving average has been problematic, as the next session, that was last Friday, was a lower, indecisive spinning top. And that was halted for moving further down by the from moving further down by the May high at 47.69, as well as the nearby rapidly ascending medium moving average, currently 47.21. Additionally, the action over Tuesday and Wednesday last week constructed a two-day homing pigeon patterns. Now, this pattern is traditionally, well, it's interesting, as traditionally they're seen as a bullish reversal. However, data indicates that nearly 6 out of 10 times these two-day actions act as a bearish continuation pattern. So it'll be interesting to see which wins out, tradition or the data. This leads me to my final point, detailed from last time, and I quote, "Finally, the simplest and perhaps the most bearish of all the ideas. It is to look at the last 5 weeks," so that's a few weeks ago now, "and this week as a potential topping action. Again, it is still too early on this, but the longer we stay up here doing nothing much other than ranging in between the all-time high, or let's say the new downtrend from the all-time high, currently at 52.65, and the support in the 5,000 to 4,900 area, then the more this pattern may grow in traction." I just wish you to know that you should not be immune to this idea as an idea. I will comment more on this as I see things happen. I think I'll just leave it at that for now. I can only say what I've said this time last week again. I'm hoping next week things will become clearer, but they probably won't. End of quote. Thank you for listening. This weekly broadcast down gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.